Hey traders, this is Blake Morrow with Trader Summit. And with me today, it's Friday. I have Mr. Jim Welsh with us. He's going to break down all the markets and everything as we race to all-time highs once again. Jim, good
Yep.
to see you.
Great to see you, Blake.
You know,
Ready for a weekend.
right, it's been a long week. I'm definitely
Yeah.
ready for the weekend. So I'm glad to have you here as I always am, and I'm sure all of our listeners are. And by the way, if you enjoy your time here with Jim every single week, make sure you give him a big thumbs up and comment down below if you if there's anything that he says that you want some more information on. But give me some information right now. I mean, pullbacks have been very shallow in the market. Stocks are going to close at all-time highs. ISM data was in the toilet today, the manufacturing ISM, but yet stocks are all at all-time highs. So tell me about this and why is this all happening?
Well, there's a lot of reasons. The fundamental reason is that the economy continues to be okay. Some of the data that came out this morning was a little softer than expected. The plus to that was that Treasury yields had ticked higher, and then they reversed and came down. So that turned from a headwind to a tailwind. But the dominant theme here, Blake, is the rampant enthusiasm for artificial intelligence, the semiconductor stocks, and same day trading options players who account for 50% of all the option activity every single day. So when you think about it, you're buying an option in the morning that has a lifespan of less than 6.5 hours. But as people do that, they force the dealer community to respond. So if I'm buying call options and the dealer sells it to me, he effectively, or that person is short the call option, and they then have to do other things to hedge that risk. And so even though some of this stuff is mindless, it still in the real world requires hedging techniques that are supportive for individual stocks and then collectively, because the concentration factor is so high in the number of stocks that are actually leading the charge, it just compounds on itself.
You
So
know,
this is just a feeding frenzy that it has to expend itself.
Jim, I've used a lot of analogies over the years. I've always found it's very easy or much easier to explain to people certain concepts with analogies. And this one is pretty easy to explain to me. It feels like we're playing a game of hot potato. If you were when we were kids, you used to play hot potato or musical chairs.
The
One of the
chairs. Yeah.
yeah, it's like you don't know when the music's going to stop. But right now, and I've
It's a
always
lot of fun.
always loved being the last two kids doing musical chairs and the music's going really fast and you're going around and around and around and it's going to stop soon and you don't want to be that one that doesn't get the chair.
Yeah.
God, what a fun game. We should try that sometime, actually. Me and you, Tim. But you point out, and I think your point is succinct here, is that you got situations where mechanically the markets continue to grind higher. And you just point out Nvidia right here. I mean, it just
Right.
continues to move, and no one
Right.
wants to get in the way. Not yet.
Yeah. And again, the fundamental story of NVIDIA is very compelling. The revenues are growing at extraordinary rates. If you look at their valuation, the earnings have increased so much that the PE ratio is probably down a little bit over the last from 3 years ago, despite this gigantic move in the stock. So, some people have tried to make comparisons to 1999, the dot-com bubble, and so forth. And those companies were very light on fundamentals and earnings.
Yeah.
To me, so that adds a legitimate base to what's going on with something like Nvidia. The sentiment, though, is very similar to what was happening then in the
Sure.
market psychology. So to me, that's the one thing that is applicable when we do these comparisons with 1999. And again, it as you said, until the music stops, people keep playing. And in markets, it means you have to have a reversal in price that lasts more than 1 or 2 days.
Yeah.
So interesting. We got the CPI, which was a shocker. Oh my goodness. The market got hit pretty hard that day. Then the PPI came out. Well, that was not great either. Yeah, but we got over the CPI so quickly, so they got over the PPI pretty quickly. And yesterday with the PCE, it was kind of like, okay, that was a temporary, like, okay, well, the market rallied after the CPI or, recovered after the CPI, didn't get hit that hard on the PPI. Why don't we rally it on the PCE? All right.
Right.
So the point I made a month or two ago, when you look at the takeaway values from 2023, so we've talked about this, all these inflation metrics are rates of change from 12 months ago. So if you take a big number away from 12 months ago and you add a smaller number, the year-over-year number goes down. It's that simple. In January and February, and we did this, I think, in early January in one of our conversations, the takeaway values were 90 basis points for January and February on the PCE. So what happened is the PCE ticked higher, but because the takeaway value was bigger, it was like 50 basis points. And so you added 30 basis points on the headline and 40 basis points on the core, you still saw a modest drop in the annual rates. The same thing is going to happen in February. I think it's about 40 basis points. So if the month-to-month numbers are a little softer, we're going to see it come down. But the point being is once we get beyond February, March, April, and May, the takeaway values are like 0.1, 0.3, 0.1.
Yeah.
My point being is obviously, let's say you don't get the 0.4 increase in core that we saw in January. Let's say it's 0.2. Well, guess what? The core PCE will actually trend up in those months. So that, I think, is what's coming. And there's reason to believe that that is certainly possible. Again, not going up by a lot, just all it goes up by 0.2 or 0.3 because of the low takeaway values. The headline and the core number could tick up. They're certainly not going to decline, as we can see that has happened over the last 15, 18 months.
Yeah.
So from the Fed's point of view, again, they keep talking about having confidence. Well, if these numbers start to flatline instead of, trending lower, that's an argument for we should be patient. We should wait a little bit longer.
Sticky,
And
sticky, sticky, Jim. Sticky,
yeah,
sticky,
yeah.
sticky.
And
All right.
Yeah.
Go ahead.
Okay. We've talked about it. You've got two types of financial conditions. You have market-based, which is what this is, based on treasury yields, stock prices, the dollar, yield spreads, and so forth. And financial conditions based on market-based stuff are as easy as all get out. They're kind of back to where they were in the beginning of 2022. And in effect, the easing of financial conditions would represent 3 or 4 rate cuts. So if you're the Fed and you're seeing inflation, okay, starting to hesitate in terms of the downward march, the economy grew 3.1% in the fourth quarter. The Atlanta Fed has 3.2 for the first quarter, very incomplete data. But the point being is no signs that the economy is giving ground yet. And financial conditions based on markets have eased significantly. Well, why would the Fed want to be in a rush? There's no need to. There's nothing prompting that. So until we see, the Fed has 2 mandates, stable prices and the labor market. And so to me, until we really see softness in the labor market, there's nothing for the Fed to actually respond to in terms of we need to do something to address this.
Yeah.
So,
how did the employment numbers in the ISM look today to you?
Well, it's softer. And in the March macro tides that I'm working on, if you look at a broader measure of employment, that annual rate of change has actually gone above 0, which is what happened prior to the 2001 recession and the 2008 recession. So under the surface, there is some softening taking place. The other thing is WARN notices. Companies that employ more than 100 people have to give their employees 60 days notice, calendar days, that, hey, we're going to have a layoff or we're going to close this plant.
Yeah.
WARN notices the last 3 months, Blake, have jumped a fair amount. Now, maybe it's just going to be a blip and they're going to wind down. But just the blip that we have seen, the increase, we're going to see unemployment claims tick higher in coming months. Why? Because companies are saying, I'm going to let you go in 60 days. Now, they may not let everybody go at day 61. And it takes a while for people then, okay, we're going to have you a severance package for some people, hourly people, not likely. There's a pipeline that starts to get created that takes a little while. But those are the signs in my mind that the labor market is slowly but surely slowing or easing, which is a good thing from the Fed's point of view, but it will lead to, as we get to mid-year and beyond, higher unemployment. So, the Fed will respond to that because it's part of their mandate. And because unemployment right now is near a 50-year low, there's no reason for them to feel like, hey, the labor market's at risk.
Yeah, it makes sense. All right. Well, hey, we're moving forward as we get into the technical aspect of Jim and I's conversation here. Just to let everybody know, we had a little bit of a technical issue today. So I'm going to be showing some of my charts, and then Jim, you're going to kind of walk us through the way you see them. And if you guys, again, if you appreciate what Jim does here, make sure you give him a big thumbs up that he's here with you every Friday here on the Trader Summit. And remember, subscribe to the channel down below. It's free to subscribe. Doesn't cost you anything. I've had people say, well, don't I have to pay to subscribe? No, it's free to subscribe, and click the bell icon, because then you get notified on your mobile device, your desktop, when a new interview from Jim comes up. All right, Jim. The first chart we're going to go into is we're going to go into the 10-year and 10-year yields. And obviously, after that ISM data, we probed a lot of support. Now, again, this is my view, not indicative of your view, but how are you looking at the 10-year yield right now?
I think that we're likely to see another push higher in the 10-year yield over the next month or two. That basically we are doing a retracement from the highs of last October. The 10-year was up about 5, got down to whatever it was, 370 something, I think, right around 380. And that we're doing a retracement.
So would this retracement be 2?
Yeah, I think that's 2 or B.
Okay.
All right. Because again, as we've talked, a longer term view of Treasury bond prices shows 1, 2, 3, 4, 5 from the March 2020 high. So back last October, I said, we're set up for a significant rally in Treasury bond prices with yields coming down. And we saw that from October to the end of December. At that point, like, hey, we're ready for a retracement. I'm not sure that retracement is complete yet, Blake. So to your point, we're getting near an area that should provide some resistance in terms of yields falling further. And then I think potentially we're going to see yields tick higher.
Well, today, today is pretty interesting because we came and, basically hit support. We're holding, but it still looks vulnerable at this point.
Yeah. I mean, again, the bigger picture, in my view, is that the decline in yields from October to December, if you look at a price chart, it's 5 waves up. If we broke it down on the 10-year, you could see 5 waves down. Again, what that implied when we got to end of December was, we're going to have a retracement. But that 5-wave rally in bond prices and 5-wave decline in the yields suggested, okay, we're going to get a retracement. But then there's another leg lower on yields coming. And I think the 10-year can get down to 330 between now and the end of the year, if you will. And what would cause that? Well, either some kind of geopolitical event that hits the economy, or in fact the economy starts to slow more than people expect.
And you've been saying this for a long time, and
months.
so the question, the question is, at this point, have we completed this move, or could we go a little
Right.
bit higher before?
So for subscribers, a few weeks ago, I recommended taking a 50% position in TLT because you can see you got three waves up. It potentially has completed that correction. So I think TLT can rally to 105 to 109 with an outside chance of 119. So it went from over 100 down to 93. And can it get down to 89 and a half? Yes. If it does, I'd be looking to add. But, putting money back to work at 93 to me makes sense since the bigger picture outlook is for another fairly significant rally in TLT.
All right. Well, that's a good view on yields. How do you feel about the dollar at this point? Because the dollar has been, pretty much, how should I say it? It's all over the place. We're getting close to the 200 DMA, and it's been sloppy.
Yeah. Well, what we've talked about is the 103.80 level.
Mm-hmm.
And there have been, I think, 3 days, maybe 4, like yesterday, where it intraday spiked below 103.80, but closed above it. And so to me, a close below 103.80 will eliminate more upside. I think the dollar is going to decline to below 100.50, which was the low back in December. Back in late December when we were talking, it's like, okay, you got 5 down in the dollar index from 107 and change. Time for a rally. A rebound to 104 seemed very likely. And as we talked, people were looking for 6, 7 rate cuts, so that ain't going to happen. And that also tied in with the idea that we were going to see treasury yields go up. So I think we're getting close to the time, Blake, where I believe the dollar is going to roll over and work its way down. And again, one of the things that could contribute to that is, well, wait a second, the U.S. economy is starting to show signs of slowing. The odds of the Fed cutting rates become more realistic, and that would lead to dollar weakness.
All right. The S&P, here we are, all-time highs.
Yep.
It doesn't look, it's a juggernaut, right, Jim?
Yeah.
What are the risks now that, and I've been kind of running around feeling this, that, we get some sort of, blow off top in the market. I mean, pullbacks are very shallow.
Yeah. I mean, the sentiment is certainly supportive of that. Back, I can't remember, a month or so ago, I pointed out that the S&P could rally to 52.19. Why? Well, because it rallied from 34.95 to 46.07. And if you add that to the 41.04 low in October, you get 52.19. So
basically,
can we get there?
This move right here, I just want to show everybody. This is, let's put it in red. What you're measuring is this to this, here to here, which would take us to 52, and change. I mean, basically, it's somewhere up here.
In this environment, it's certainly possible. All right.
Yeah.
What you can see is the bottom part. It looks like RSI.
Yes, it is.
So we're making these higher highs. The RSI is diverging rather noticeably, and the most recent print is under 70. So to me, RSI divergences, it's like you throw a ball up in the air. Even as it continues to gain altitude, the rate of change is slowing. And that's what the RSI is. But if the RSI is 80, that's still really strong. It's like the ball's going up at 60 miles an hour instead of 30. So RSI divergences under 70 have historically been more predictive of a price reversal. I've shown the 21-day oscillator of advances and declines, which is kind of a similar concept, but based on market breadth. That has also been diverging. Now, historically, Blake, that combination has fairly reliably preceded corrections. It's not and hasn't happened the last 2 or 3 weeks, especially last week after Nvidia came out with their blowout numbers and the S&P was up 105 points. But, those are warning signs, in my view, that a correction and the probability of one is increasing. But given the mindset of those who are doing, some significant trading, until something leads them to think, you know what, it's really in my best interest to take, a lot of money off the table in some of this stuff. This can continue to run, but the
Yeah.
underlying technicals are warning, that in a sense, it's like a pyramid. It's got a big base at the bottom and a point. So what's ineffectively happening here is the pyramid is being flipped upside down. So that point is supporting all that weight. And slowly but surely, what the RSI is saying, what the breadth indicators are saying, is that that weight is being supported by fewer and fewer stocks and less upside momentum, which again, historically works really pretty good if you measure this stuff, in terms of setting up a correction.
Now, Jim, just so everybody's clear here, what could also happen, the counter argument to that is relative strength could break out, and
Yeah,
you could see a price breakout to the upside.
Yes.
So that's
Yes.
entirely possible.
Until you get a price reversal.
Yeah.
There is that,
Right.
and things like the 5-day moving average and the 13 exponential moving average, 5 crossing below the 13 or above. Those are nice signals, and they're great trend following tools. And, they've been positive pretty much all the way up since January. The 5-day has been above the 13 days. So to your point, that's one of the Achilles heel of the RSI indicator is, well, look at it, I got divergence. Oh, wait a second. I just got run over by a bus.
Right. Right. Exactly. All
Especially
right.
where we are.
Go. I'm sorry. Go ahead. You were
No,
finishing.
just the psychology of where we are.
Yeah.
So, okay.
Last but not least, gold. I mean, gold has been strong, and here we are back at that major high, that triple top 2070, 2075, somewhere around here. We're up there today. What do we do, Jim? I mean, gold's been acting pretty damn well despite the dollar's strength.
A week ago, I recommended buying gold because I thought, all right, I thought that we were going to have 2 weeks ago when we talked, it was like, hey, gold is getting ready to dump. And it dropped below 2,000, but it didn't follow through. And so to me, that lack of follow through kind of like, okay, it should have, but it didn't. And that led me to kind of conclude that, you know what, maybe this thing is finally ready to go, coupled with my view that the dollar was in the process of rolling over, that if in fact the dollar did, we would see gold rally. And your red trend line there, obviously connecting the prior highs, broke above that kind of convincingly. To me, there's a good shot that gold's going above the high we saw in May, which was what, 2107 or
21, yeah, like 27, 28,
22 or something. I don't know.
28,
I think it's
2130s is spot, but depends on what
yeah.
you're looking at. But yes.
Yeah. And so, my view has consistently been at some point in time this year, gold's going to make a move above 2,300. And to me, this might be the opening salvo of that move beginning. A lot of things coming together, especially with the dollar appearing to be on the cusp of breaking down. Now, the other thing that's interesting, Bitcoin's been going nuts. And there's a fair amount of speculative money that trades Bitcoin. And if we see a price reversal in Bitcoin, now all of a sudden you got a weaker dollar. If the Bitcoin starts to weaken, I think potentially that's a supporting factor for a rally in gold.
And I don't disagree with you, Jim. I mean, I, I know I said this earlier this week, and I hate this pun, but Bitcoin has taken some of the shine from gold. I mean,
Yeah,
in this generation of people that are looking for safe, Bitcoin is, I've transacted in Bitcoin. I bought and sold in Bitcoin uh, before. So I know
yeah,
how it transacts. I've also bought and sold gold before. I know how it
yeah,
transacts, and I can guarantee and safely say it's a lot easier to transact in Bitcoin. Also, it doesn't take up space in my safe
your closet.
and a closet in the closet safe. It doesn't take up space there,
Underneath your
or at the
bed.
bank in your deposit box. But the
Yeah,
fact of the matter is that it is an easier, if it's going to be looked at as a safety mechanism or something to hold, for safe reasons, for all the other reasons why you buy gold. You can see why gold's kind of lost its luster a little bit.
yeah, yeah. I mean, I think that's been, you say lost a luster. More importantly, it lost flows. You
Hmm.
know,
Yeah.
that, a lot of, millennials, I think, are much more inclined to embrace Bitcoin, whereas older folks, because that's what we've known, would be looking at gold. But it's money flows. And I just think that there's the potential that gold can regain, at least for a period of time, some attraction if these other instruments start performing less well.
Yeah,
Yeah.
and that makes perfect sense to me. It does.
So,
I don't want to call Bitcoin the anti-gold, but as many people see it as the anti-dollar. But I do think it takes away some of the prestige, and if you get Bitcoin selling off, maybe you get some of that money coming back into gold. So I
yeah.
could
Well, the other
definitely
thing,
see it.
we just went through a big bout of inflation, and gold really didn't capitalize on that. So if you've been a person who has owned gold because it's an inflation hedge and it fails to perform, you're going to be open to, well, that stuff is really moving. Maybe
Yeah,
that's the stuff I should be having.
right.
So anyway, based on the chart has been indicating, I have thought that there's a nice big move coming. Again, there was a 5 wave rally in gold to that May high last year. It implied then we were going to have a pullback. It was just a question of how deep would that pullback be before we would see wave 3, taking gold to new all-time highs, begin. I think there's a reasonable probability that it's starting to happen.
Yeah, yep, and I hear exactly what you're saying, and so let me just say, Jim, it is great to have you here on Friday. I know we had some technical difficulties. Really nice to
Murphy,
have
it's
you.
March, and Murphy made an appearance first day.
Right, right, exactly. I want to say just thanks for being here, and
Yeah,
I know
my pleasure.
everybody listening at home would like to thank you. What's the
Oh,
best way to follow your work, and how do I?
macrotides.com.
All right. Macrotides.com. Send you an email, right?
Yeah, Jim Welsh Macro at Gmail. I'll send you a recent report. You know,
Awesome.
anyway, no, I love doing this, Blake. It's a lot of fun. We have good conversations. I think for those who are listening on a consistent basis, um, I think our analysis has been above average
Hey, you
for
know what,
a
Jim? I'm
chunk of
just I'm
time.
just an I'm just a bystander. Your analysis has been awesome. So thank you
Well,
so
you're
much
smart
for
enough to agree with me. Come on.
thank you for so much for providing it each and every week. And if you guys and gals
Yep,
enjoyed it, make sure you give them a thumbs up. Jim, I look forward to speaking with you next Friday, and we'll get these technical issues sorted out.
I hope so. It's up to Murphy.
All right. Take care.
See ya.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.